Is the Fed hiding hyperinflation? Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's ask the question if the Fed in the US is hiding hyperinflation, because frankly that's going to have an impact on all of us. So I've just got a chart here showing you the huge, insane increase in M1 money supply. And you'd think, just looking at that, okay, hyperinflation, obvious, so prices are going to have to skyrocket. Let's have a look at a bit more of the information here and try and get a feeling of what's going on. Because what's come out is the Fed, they've stopped releasing their weekly updates for a lot of these money supply data points. They're not releasing it weekly. They've been releasing it for decades, every week upon week upon week. Now all of a sudden, it's moved to monthly. So if you put your tinfoil hat on, one could ask, is that perhaps to alleviate certain consumer issues or to help manipulate and push behavioral economics? Or maybe they just really like the current administration? You tell me. Let's have a look. So first, to start off, we need to look at what M0, M1, M2, M3 money supplies are, just so we have an understanding of it. Now, the monetary base, or M0, it's the total amount of currency that is either in general circulation in the hands of the public or in the form of commercial bank deposits held in the central bank's reserve. This measure of money supply is not often cited since it excludes other forms of non-currency money that are prevalent in a modern economy. So M0 really isn't, you won't see it discussed that much. So it's also known as M0. The monetary base is sometimes referred to as high power money, as it can be expanded through the money multiplier effect of the fractional reserve banking system. Economists typically look at more comprehensive monetary aggregates such as M1 and M2 instead of the monetary base. Okay, so we need to know what M0 is. No one really refers to it that often. M1, the next one up, is the money supply, which is composed of physical currency and coins, demand deposits, traveler's checks, and other checkable deposits, and negotiable order of withdrawal, NOW, accounts. M1 includes the most liquid portions of the monetary supply because it contains currency and assets that either are or can be quickly converted to cash. However, near money and near money, which falls under M2 and M3, cannot be converted to currency as quickly. This is the thing you've got to realize. Having just paper wealth can evaporate quickly, particularly if you've made good money in an investment or in crypto, and then you want to try and turn it into something you can use. That paper wealth can disappear really quick, depending on the liquidity of the market. Key takeaways. M1 is a narrow measure of money supply that includes physical currency, demand deposits, traveler's checks, and other checkable deposits. It's no longer used as a guidance for monetary policy in the United States due to the lack of correlation between it and other economic variables. Okay, so it's no longer used. M2, the next step up. M2 is is a calculation of the money supply that includes all elements of M1 as well as near money. M1 includes cash, checking deposits, while near money refers to savings deposits, money market securities, mutual funds, and other time deposits. The assets are less liquid than M1 and not as suitable as exchange mediums, but they can quickly be converted into cash or checking deposits. So it's a measure of money that includes cash and easily convertible near money. It's a broad measure of the money supply, broader than M1, which just includes cash and deposits. It's closely watched as an indicator of money supply and future inflation, and as a target of central bank monetary policy. So then we have M3, the next step up, everyone. M3 is the measure of the money supply that includes M2, as well as large time deposits, institutional money market funds, short-term repurchasing agreements, repo, and large liquid assets. The M3 measurement includes assets that are less liquid than other components of the money supply and are referred to as near money, which are more closely related to the finances of larger financial institutions and corporations than to those of small business and individuals. M3 is a collection of the money supply that includes M2, as well as large term deposits. It's closely associated with large financial institutions, traditionally used by economists to estimate the entire money supply within an economy, and by governments to direct policy and control over the medium and long-term periods. As a measure of money supply, M3 has largely been replaced by money zero maturities. M3 is still published as a source of economic data, but mostly for ease of historic comparisons. So there are the M0, M1, M2, and M3 money supply definitions. So as we keep going, I want to look at just the definition of inflation over time. So we've seen the different definitions of money supply. There's a fair bit of stuff we need to cover in this video, guys. Now, when people normally think of inflation, they think of increasing price of goods, but that was not always the traditional definition of inflation. Traditionally, inflation was simply considered, and we'll have a look here. We'll go right back to 1755, a dictionary of the English language, the state of being swelled with wind. Flatulence, okay? So that was the first one, swelled with wind, okay? Inflated. Now, how can that possibly relate to money? Well, you inflate the supply, the amount of money. This is from 1864, Webster's American Dictionary of the English Language. Undue expansion or increase from overissue, said of currency. Okay, overissue. Here's from 1889 to 1891, the Century Dictionary. Undue expansion of elevation, increase beyond the proper or just amount of value, as inflation of trade, currency or prices, inflation of stocks. So you've got here currency, you've also got prices and stocks introduced. And then a dictionary of American English or historical principles, 38 to 44, of money and prices over expansion. And steadily, money has seemed to have just dropped away, where now they're just defining it as an increase in prices. And we've got all of these different measures of inflation that, well, here in Australia, they don't count houses. Or sorry, they don't count the land, because it's considered an investment, but it's going to have a huge impact on the economy. If they just included houses properly in inflation here in Australia, they would have hit their CPI targets. So, the definition of inflation has changed over time to kind of evolve, and the language has changed where people think it's just to do with prices. Traditionally, it's just to do with the increase in the supply of money. Now, if we have, before we go into hyperinflation, if we have an increase in the supply of money, then what we have is the Cantillon effect. The Cantillon effect refers to the change in relative prices resulting from a change in money supply. The change in relative prices occurs because the change in money supply has a specific injection point, therefore a specific flow path through the economy. And usually those that take advantage of that new increase in money supply and inject the money into that flow path, or the first few steps with regards to the velocity of money, they get the greatest benefit or the greatest purchasing power of it. While the plebs, the normal people, don't reap any of the rewards. So then the other concern now is hyperinflation. This is the question, what is hyperinflation? Well, when we all think of hyperinflation, we think of the Weimar Republic, good old Germany, stacking the Deutschmarks as high as the eye can see. There you go. I mean, look at that. Just nuts. Crazy. Could we see this? Well, look at how much money has been added to the certain money supplies. Maybe. There's the question. So what is hyperinflation? Is a term to describe rapid, excess, and out-of-control general prices in the supply of the economy. Now, they're defining it as prices in the economy. But we just saw that the definition of inflation has changed over time, where it's to do with the supply of money. And supply of prices should be both. Although hyperinflation is a rare event for developed countries, it has occurred many times throughout history in China, Germany, Russia, Hungary, and Argentina, typically measuring more than 50% per month. So, is the Fed hiding hyperinflation? Depends on how we look at it. Okay, depends on what terms we're using. And, well, language changes. Is it justified or is it changed on purpose? So the US core inflation currently is at 1.3%. Not too bad. For this, they're removing food and other highly volatile items, which affect it. But 1.3%. He wants to get it to 2%. So let's have a look. This is the money supply. This is weekly data, and this is what they've stopped updating. M1 and M2 weekly data. They're now moving to a monthly release of the data. The question is, was that done to, well, influence behavior perhaps? I mean, just have a look there. Look at that huge increase, everyone. That's insane. I made this chart. I got the data from the St. Louis Fed. And what I've done here is I've looked at it. This is from monthly data. I've looked at its change from the previous month. And so you can see here the average change is 0.12%. Oh, wait, no, that was the weekly one. Look at this. So I've jumped back into my Excel, and I'll bring this here and show you. I mean, this is the data. This is, you can see here, the recording date, and I've done the change on money supply from one period to another. What is changing? Now, before here, 2020, 0501, we had, before that 200% increase, even counting this 11%, which is insane, the average, including that 11, is 0.49. If we look at everything going right back to 1959, the average is 0.47, everyone. Now, after, if we include that 240% increase, that's from one month to the next, it doubles the average to 0.81. And then since this data here, after this huge spike in M1, like insane, guys, that's the average. That is the average change from 1 month to 1 month, is 0.49%. We had 240.98%. They'll give an explanation as to why this happened. Now it's gone at 1.38. So even that is nearly 3 times what the average used to be. So there you go, everyone. We've had a huge amount of money supply increase. Just insane. Here's the M2 money supply. This is weekly data. Again, you can see, look at this, the same thing. It's growing significantly. And now here's the M2 changes from the previous week. Now, this is based on the weekly data. Remember, this data isn't going to be coming out weekly anymore. This is what they've removed, this information. We can see here, you know, it's going up, maybe 1%. Here we go, shooting up, boom. Another big spike. And still, look at that increases since then. So M3, now they don't publish M3 anymore, so I would encourage you, if you're interested, and particularly if you're, well, skeptical a lot of the statistics that are put out by the Fed and, well, any government, look at the shadow government statistics, the website here by John Williams, and you can see, well, here's his M3. He's continued it on as well. It has skyrocketed, and I will put a link to this one in the comments below. It may be a little concerning to you. So why would the Fed hide inflation? Why wouldn't they want to show it? You know, or are they worried about hyperinflation? Now, there's a few reasons that an argument I'll put forward to you. Here's jobless claims, everyone. Okay, look at that spike. That was just insane, and we know why. It's shooting down. The government over there has intervened into the economy. Now, a big part of economics is behavioral economics, and it's, well, to do with the psychology and human behavior. Now, that's influenced by news, that's influenced by information put out there, that's influenced by propaganda. Remember, these central banks, they want stability. That's essentially what they want, and more control. One might argue. What do you think they're interested in? Do you think they'd bend the truth or restrict information to achieve their goals? Here we have a look at consumer confidence as well. It's slowly going right back up, everyone. You know, the more positive news, the more spins that you have, the less information that you have out there. If you release something once a month, and not 4 times a month, there's not going to be as many articles written about it. There's not going to be as many people talking about it. Will it have less of an impact? And here we have the NASDAQ shooting to the moon. We've got the S&P 500 shooting to the moon. We've got the Dow Jones Industrial Average shooting to the moon. And you know what that's all going to do? That's going to influence the wealth effect. And this is, you know, it's in behavioral economic theory, suggests that people spend more of the value of as their assets rise. The idea is that consumers feel more financially secure and confident about their wealth when their homes or investment portfolios increase in value. They're made to feel richer even if their income and fixed costs are the same as before. Now, could this information be intentionally restricted, perhaps for political reasons or economic reasons, to influence the wealth effect? And the wealth effect, we can have an increase in the velocity of money. Now, here we go. Look at this. Look at this. It's just been going down further and further. What's the velocity of money? It's a measure. The velocity of money is a measurement of the rate at which money is exchanged in an economy. It is the number of times that money moves from one entity to another. It also refers to how much a unit of currency is used in a given period of time. Simply put, it's the rate at which consumers and businesses in an economy collectively spend money. It's measured as a ratio of GDP to M1 and M2. So the velocity of money, I mean, it's in the toilet, guys. Look at that. Ever since the GFC, it's just been going down, down, down. How's that going to impact on the economy? So perhaps they're, not worried about putting this information out there because, well, they've got an incentive to increase the velocity of money and increase people's spending. The Fed's argument for the recent surge. Now, they're saying essentially, due to changes in requirements, money has been moving from M2 to M1. That's the argument that they have for it. No mention of the essentially infinite QE program that they have in the US. So solutions, everyone. Solutions. Well, there's a few. Let's have a talk about this. Watch The Hidden Secrets of Money by Mike Maloney, everyone. I'd recommend you all have a look at least to have a bit of an understanding of it, if you haven't already. I'm sure a lot of viewers of this channel have. Do you invest in gold? Many people are investing in gold as a way to hedge against inflation, but it's not doing too well at the moment, everyone. I'll just bring up a trading economics here. We can see where's gold sitting at right now. Commodities, gold is down 17.54, silver as well, even with the squeeze. There you go. Look at gold. Ain't doing too good. Silver, $25.42 US. Do you invest in gold? Do you invest in silver? Do you invest, silver, you got to also take account of, do you invest in a synthetic product where you may never actually see it physically, or do you buy it physically as well with gold and silver? There's a cost associated with that. Do you invest in cryptocurrencies? Bitcoin is going crazy. What is it? We'll have a look at the time of recording, where it's sitting at. Coin market cap, there you go, 58,000 US. Look at Ethereum, 2,000, guys. Is this the new gold? Are people jumping into these out of fear? What about central bank digital currencies, everyone? That's another scary prospect on the horizon. Do you invest in property to try and hedge your bets against this inflation? Do you have piles of cash that, well, are going to potentially lose their purchasing power? Or do you invest in real physical assets, businesses, farmland, things that can earn you money? Or should you never bet against the Fed? Or should you sue the Fed? We'll look at that next. Or do you think the US economy is going to boom like Jamie Dimon from JP Morgan? Is this their Goldilocks moment? Stimulus spending, infinite money flowing. Will it be a good time to invest? What are you doing, guys? I personally, I'm diversifying a little bit in everything, to be quite honest. US stocks, not being against the Fed, a bit in gold, a bit in silver, even a little crypto. Property, adding value to my house, because that's something, regardless, it's something that I'm going to need for years to come, particularly with a growing family. The problem is, if you go down rabbit holes, one side or the other of these arguments, you can wind up just looking for confirmation bias and news sources that only back up what you want to hear. Then you might not see a clear picture. But you could also argue for, well, we can all agree, sue the Fed and get them audited. What do you think, everyone? These organizations that have this ability to literally create money out of thin air and not instantly, but technically reduce the purchasing power of every dollar you've earned and all the hours you've worked for. So, thank you all for watching this episode. What do you think, everyone? Do you think there's a risk of the Fed hiding hyperinflation. Are you preparing for it? What are you investing in? Gold, silver, crypto, property? Or are you just watching from the sidelines just to see what will happen and you think it's going to be a new golden age for the US? As always, let me know your thoughts and opinions on this one in the comments down below. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. Take care, guys. I'll see you next time. Bye for now.